G'day there. Welcome to the Closing Bell on the 22nd of October. Today, I want to really look at very big picture dynamics to give you a sense of really how important what's going on is. The fact that what we're seeing is not just your run-of-the-mill jump in rates that will soon enough come back down again, in my view. I think this is a pretty dangerous time. I've been really talking about this for quite a while. Finally, markets are really doing the stuff I was talking about, at the start of the year, what I thought could really happen. And we're sort of getting near the business end of proceedings. So I think it's a good idea to just have a bit of a recap and a think about what's actually going on here and consider some of the potential outcomes that may be coming. I know I have been going on about it for a while, the fact that the S&P could crack and things could really sell off sharply. That has been my overriding theme for quite a while. So I'm hoping many of you are feeling that you're prepared for what may be coming. But I thought just looking at a few really long-term charts might give you a bit of a deeper appreciation of the situation and the fact that really this is a market of capital preservation. That's the story at the moment and has been for a while. I know members of my services would know that I really haven't been doing that much, and it's been frustrating for me, as I'm sure it has been for them. Every now and again I'll do something, but I really have found it hard to find something worth doing. And really, most things are heading down. Gold's heading down. Stocks are heading down. Bonds are getting hammered. We're really seeing a complete deflation of assets across the board as rates get ratcheted up. There's a lot of talk at the moment about, inflation. Really, the figures they're looking at being in the rearview mirror. Elon Musk coming out and saying he reckons he's seeing more deflationary impulses than inflationary, and he's worried that the Fed is going to raise rates too far as things are slowing down rapidly. There's a lot going on. The energy crisis in Europe, that is going to take off as they head into winter. The stories I hear about what's going on in the UK, $10 to heat your oven for an hour. It's just sounding like things are getting a bit out of control. And really, do you want to be looking for nickels and dimes in front of the steamroller when something really big could be afoot? And a lot of things can unravel if rates keep going higher. And I want to start with the US 10-year yield. I know I often do this, but let's have a look at it on an 80-year view and see what we can see. So here is the US 10-year bond yield going back to 1913. So what can we see here? Now, I've split this up into two 40-year periods. You can see this period going into the Second World War, rates going down. We've got about a decade of rates flatlining, and then we've got that breakout, and rates were then on a one-way trajectory for the next 30 odd years, going up into the Volcker moment. And since then, really our whole generation, since I was a young kid, we've had rates going one way, down. And that has fed into a massive asset price boom, as we'd all know. And just analysing what's been going on here the last decade, this is the thing that I've been focusing in on for you, talking about this breakout, this decade long high in yields at around a bit over 3%. And I was saying, look, what happens once it breaks out above there? And we are seeing what's happening. That breakout is looking quite dramatic. And I want you to get that sense of the possible end of a long period of downtrend, the sideways motion at very low rates, and then the break out to the upside. Now, which one are we in at the moment? Are we in this phase of breaking out and then having a recovery for a while before it really breaks out? Or is it at that stage where it's going to surprise everyone to the upside before things roll over? No one knows the answer to that, but I just want you to get that sense of the possible end of a multi-decade downtrend in rates, that we've had a decade of sideways motion, and then we've had the first breakout above the lowest high in yields in that trend as it heads down. There it is there. This is the bust out. And this is the one that I've been saying, watch out, because this is when you can get forced liquidations, shift in trend, and how high does it go? We don't actually know yet, but this is the thing that can cause problems if it really does ratchet higher at a rate of knots. So, everyone usually looks at markets from the point of view of, it's overbought, it's oversold. But if this is a real shift in trend, what does overbought really mean? Now, with the 10-year yields, I can tell you there were people saying what I'm saying here as well. There's been many false dawns of, rates heading higher, and every time it's ended up turning back down and heading to lower levels. So this could be the case with us if they raise rates too quickly, and there could be a big liquidation going on here. But then if growth really plummets lower rapidly, inflation, the heat comes out, the Fed freaks out, maybe that could be it for a while, and it could drop before possibly heading off on that big uptrend. But the point being, you've got to allow this breakout, this multi-decade or this decade breakout to go and do what it needs to do. Saying that where it is now is too high and that it's going to come back down is going to look pretty foolish if it just keeps going and you're just getting long bonds in the face of a steam train of selling. And you've got to think about these leveraged strategies, like risk parity strategies that leverage up into bonds and equities, but they might be 60% equities, 140% bonds, and usually over time that's going to even out. Bonds move one way, stocks move another, and everything is fine. But what about when stocks and bonds get hammered? All of a sudden you're leveraged and wrong in both legs of the strategy. So that's been a very popular strategy, and are they just forced to dump? And then it's got to overshoot before real buying steps in, saying that the yield looks pretty good compared to a terrible stock market. But this is a sort of setup when you're looking at that from a multi-decade point of view, end of a 40-year trend, turning up the rates and really screaming higher on a big breakout. And that can lead to all sorts of problems. So if we have a look at the S&P 500 as those rates are flying higher, I mean, the S&P 500 has been holding in there pretty well with these US 10-year bond yields flying higher, but it is starting to weaken off again. And the first thing to note, if I'm looking at my trends, and this is a monthly chart, we've got the 20-month simple moving average, 10-month exponential, and I look at the Bollinger Bands around that, 1, 2, 3 standard deviation Bollinger Bands. And I really use that 3 standard deviation Bollinger Band just as a thing that I'm tracking. And if prices really, especially on a monthly basis, close below there, the highest level of that 3 standard deviation Bollinger Band, that's really when it's like lights out, when the trend could be turning down. If we look back here in 08, things started to turn down. The long-term trend turned down as far as the 10-month exponential crossing over. We had a retest of the long-term, and then it cracked. Once it cracked below that 3 standard deviation Bollinger Band, that was pretty much the crash. And if we go back further, it's a similar situation of just watching these trends. The 10-month exponential crosses, okay, things are looking weak. But then really once it cracks below that 3 standard deviation Bollinger Band, you've then got a year of selling into the lows in 2003. So it's just a little thing for me that I sort of keep an eye on as far as when things can really get out of control. Often when the market is trending up, the 1 to 2 standard deviation Bollinger Band below in an uptrend will be support. So you can see there again, buying pressure coming in over and over in this 1 to 2 standard deviation below the moving average. And even again, that was the 2020 crash. It was a very quick spike below there. That was when it was real panic stations. But the monthly close wasn't below there and turned back up, still within an uptrend. And then off we went for that amazing run to the upside. And now the heat really is coming out of that big trend, which was based on massive stimulus and printed money. So we're sort of at the business end of proceedings as far as the trend goes, saying, well, we really do need to find the support coming in. And it still could. We still could be in for that bear market rally, as long as we sort of hold above these levels. We've had some buying pressure coming in. But when you look at this monthly marching down of price action, we've got the monthly sell pivot there. We've got the change of trend there. I was telling you about the retest, that if the retest saw selling pressure, watch out. And we've sold off back to the lows. We're now doing a lot of work around this low because it is so important. If the buying pressure comes in and it holds above that major level here and, creates a little monthly buy pivot, the buying pressure comes in, that might be the beginning of the next wave up. Certainly has happened many times in the past. It always looks terrible at the bottom, but once it turns up, all of a sudden that's the beginning of the next wave higher. So playing devil's advocate on what could happen, this is a spot where the bounce would happen, but it's finding it difficult, isn't it? And the selling pressure is there where I'd expect to see it. So we're waiting to see what happens next as far as, does this low give way? Do we crack through that level? And do we see that very impulsive decline, which is really my sort of main case that I'm expecting to see ultimately. But it's a matter of timing, and markets do stuff around for a lot longer than you can ever imagine. So looking at this whole wave higher from 2020, and we're analysing it based on these buy and sell zones that I keep talking about, with the buy zone down here, the sell zone up here, and the point of control here. So you can see the low of this recent selling pretty much hit that point of control bang on. That's the point where you want to still see buying pressure, and it could still come in as long as it holds above there. It'll try to rally to meet the selling pressure. But then if it cracks through there, that's when often the momentum can shift quite rapidly, and it can be a pretty quick trip down to that buy zone area. Now that might be it. That could be when the Fed does the pivot and says they're nearly finished raising rates. Maybe inflation figures start coming off the boil, growth starts maybe slowing rapidly, or unemployment shifts up, and people take that as a bullish sign that they're going to stop raising rates. Who knows? But that is a good candidate for a spot where there could be a good chance of a good rally to the upside. And really, it becomes Armageddon-ish if it doesn't hold there and cracks below that low. Well, boy, that's a real bad situation. And you can't discount that as a possibility because we are in, as I said, that quite special situation of seeing a shift in a 4-decade long trend in interest rates, and with inflation putting the Fed's back right against the wall. So it really is a fairly serious situation, and the charts are certainly doing everything as you would expect based on past behavior and where the real selling pressure can kick in. I mean, we're close to that sort of a situation here. And if we go into the weekly chart, you can see that the weekly downtrend is now back in place after that, attempted rally and the squeeze met selling pressure. And again, notice the 1 to 2 standard deviation above that 20-week moving average being the spot where things turn down. And if we just look at how it's developing, notice the selling pressure coming in recently at the 10-week moving average, selling off again towards the lows. Notice that there is no weekly buy pivot. The most recent pivot was that weekly sell pivot here. So you see prices marching higher. The weekly close below the low of that highest price candle there. The selling pressure coming in where I expect to see it. The key bars marching down as it goes lower and lower, and no weekly buy pivot in place. You can see the lowest price candle there. You need a weekly close above that. We just poked our nose above there, but the selling pressure came back in. So really need to see a weekly buy pivot from here for me to say, look, short term, we could see a bit of a run. And the alternate is, quite serious. If it just keeps going and can't hold, and with the US 10s looking like they are, that may be what we're in for. So it's just one of those situations which you don't see very often. I guess I'd say, is it going to crack? Well, usually you'd say it's a, very, very small percentage chance. Let's say 0.5% chance. And if I was to say, well, it's 20 times as likely to happen, so there's a 10% chance now. Well, you'd still say, well, it's a 90% chance it holds in there. So it's still a very low probability, but it's 20 times as likely as normal. And I don't know if they're the right way of going about it as far as probabilities, but it just gives you a sense of what the situation is. So, that's really all I need to go on about, I think, today, just to really drive home that point, something that I've been talking about a long time, following this whole downtrend, how it's developing. I've picked the bear market rallies. I've told you about the points where prices could sell off from. And now we're just at that final point saying, is it actually going to crack? And you can see quite a panicked move to the downside if it can't hold in there, and if those US 10-year bond yields really do start ratcheting higher at a rate of knots. So that's really all I wanted to talk about today. It was something I've been discussing a lot anyway, but it was just to drive the point home that this is big picture stuff going on, and with the energy crisis thrown in, and which is feeding inflation even more, especially in Europe. And things probably will start to soften off a lot, I guess. And the Fed is still not letting up on their desire to keep raising rates. Those 10-year bonds really flying. It's a situation where you'd be focusing on capital preservation more than anything else, because there's no easy money out there to be made at the moment. I think once the capitulation happens, there will, but it's just heating up out there. So tread carefully. All right, well, I will come back with more next week. Cheers.